My name is Jeffrey Kennedy, and welcome to Trader's Classroom. A common misconception about the Elliott wave principle is that the forecasts that we make based on the wave patterns, they're static. They don't change. This unfortunately isn't true because as new price action often unfolds in on the price chart, it often changes the actual context of prior price patterns. In today's episode, what we're going to be doing is actually discussing realistically what you can anticipate or expect by applying the wave principle to price charts, and also to have a better understanding of the evolving nature of a price chart and also of financial markets in general. Let's begin. Now the price chart in front of you is that of Netflix, and we actually looked at Netflix, and this price chart I did, this is the original price chart that we did, I believe, in November, mid to late November. And essentially what we were looking at this point, we were looking at waves 1, 2, 3, identified this as a triangle fourth wave, and then waves 1, 2, 3, and then I was anticipating a 4 and 5. So if we move the price chart over to the right a little bit, you can actually see logically how and why I came up with that forecast. Waves 1, 2, 3, here's our triangle, up, down, looking for a third wave move, looking for prices to actually exceed the prior wave 3 extreme, and do so in a blue fifth wave structure. So that's what we were looking for at that time. Well, look what's happened since then. We've actually have more price action. Okay, well, more price action allows us to re-examine Netflix and come up with a new labeling. Now, does this take away from the credibility of the Elliott wave principle? I don't believe so, because what it actually does is it gives me a tool that I can constantly utilize to address what's happening right now. For example, if we look at an updated price chart of Netflix, for example, this one, here's one interpretation we can still work with, provided that the current decline that we're looking at right now does not fall below the wave 1 extreme. Now, the reason this level is important is because, as you know, wave 4 may never end in the price territory of wave 1. So this is actually would be a rule violation. Also, too, it gives us a clear, decisive point to the penny of where this interpretation is no longer viable, or more importantly, at a level where we can actually change our mind as far as our outlook in Netflix. Let's take a look at another interpretation. We have waves 1, 2, 3. I'm labeling the triangle a little bit differently. Here we have waves A, B, C ending here, then waves D and E. Now, if this is the correct interpretation, we have waves 1 up, and we're currently working a wave 2 pullback, meaning that we still have waves 3, 4, and 5 to go. So what's my point in actually discussing this? Well, again, I want to go back and actually discuss the misconception that an Elliott wave forecast is static. It doesn't change. Well, of course it will change. It will change as new price action unfolds on the price chart, because that new price action that unfolds in the price chart is actually new evidence, and that can either continue to support a bullish outlook, or it actually may change, say, a previously bullish outlook into a bearish outlook. Again, I find great value in the wave principle because, again, it allows me to actually examine not only what's going on in, say, right now, but it allows me to evaluate past price action and gives me a really good roadmap of what I can anticipate moving forward. More importantly, it identifies, again, key and critical levels where I can focus on and actually trade against. For example, in this interpretation here, the second interpretation, we know wave 4 cannot end in the price territory of wave 1, so if we continue to push a little bit lower today in Netflix, then this interpretation is not a possibility, period. End of story. We can actually eliminate this price chart and eliminate that possibility from contention. Now we have this interpretation as well, meaning that the actual November low is going to be our critical support level. Now, if we fall below here, what happens? Well, that means we have more price action. More price action will have unfolded to actually change the larger outlook. I guess the point I'm trying to make is applying the wave principle is very much like driving a car. You need to be, it's a very fluid process, and you actually need to be very flexible in the approach. For example, you don't get behind the wheel of a car and just simply lock your hands on the steering wheel. What you do as a driver, you're making minor adjustments in the steering wheel to stay between the lines. And that's what we do as Elliotticians. We're always updating our price charts. We're always examining price action, new price action, to see if it continues to support our prior or previous forecast or outlook, or if something more dynamic is actually going on that may actually invalidate an interpretation that we had previously. Let's look at a few more price charts. Now, this is what we were looking at. We discussed, I believe, in November, maybe even in October. We were utilizing this price chart of Microsoft in a discussion on price gaps. Notice the acceleration gap. And this is the original price chart, and it goes back to, say, early November here. And what we were looking for, I think the lesson here was how if you miss a move like this, the acceleration, a big price move up, don't worry. There's always going to be another trading opportunity. And as I explained here, you would have had a second and even a third chance to participate in an additional upside. But this is what we were looking for then. Well, since then, we've had a lot of price action unfold in this market. And what that allows us to do is kind of reevaluate the wave patterns, update the wave patterns to see if everything is continuing the way we originally anticipated, or if something more fundamentally has actually changed in the underlying issue. Well, here's an updated price chart. Here we still have our waves 1, 2, 1, 2, 1, 2, 3, 4, 5 for 3, 4, 5. So we're currently working our blue wave 4 here. So the outlook for higher prices, which did indeed come to pass, just as they did in Netflix. But again, by updating our wave patterns, we can continue to make sure that the original bullish case is still holding together, that nothing's actually changed or actually damaged that outlook. We might see maybe some weakness this week as we see this wave 4 develop or unfold a bit more deeply down to the 236 retracement of the wave 3 that comes in at 52.84. Now the reason I'm looking only for, say, a 236 retracement is it's still fairly near the previous fourth wave extreme of 1 lesser degree. And also too, whenever a trend is deeply ingrained, as I believe it is in Microsoft, counter trend moves tend to be more shallow, so we often don't see a full 382 retracement. Now let's look at one more stock and we'll call it a day. Okay, now here is a stock that we looked at, I believe in November, maybe even October. This was Ctrip. Now you'll notice my numbers are floating way up here, okay? Well, why is that? Well, something happened in this issue. We actually had a stock split, a 2-for-1 stock split on December 2nd. So now, okay, our outlook in this market was for higher prices. We were looking for a couple of 3s and 4s and 4s and 5s to the upside, but we had the stock split. I wasn't anticipating that. But what we can now do is actually come back with this new price action and still see if our original idea, our original hypothesis of higher prices in Ctrip, whether or not that still holds water, whether or not that's still a strong case that can be made, but more importantly, whether or not price action continues to support that outlook or have wave patterns changed. As I say quite frequently, for example, in many of my seminars, I focus a lot on Elliott wave patterns, very specific patterns. For example, this move here to the downside. This is a counter trend move. We discussed it before. It's a 3-wave structure, waves A, B, and C. Now, we could identify this as this extreme and this low as, say, 1, 2, or 3, 4, or possibly even A, B. The actual assigning or designating the degree of that structure, in my opinion, is not as important as actual pattern identification. Regardless of how you identify this move to the downside, it is a counter trend move, period. End of story. This is an A, B, C decline, okay? It's not an impulsive decline. It's not an ending diagonal. It's not a zigzag. And now the reason, it's not a contracting triangle. The reason that pattern identification, being able to identify it as a pattern, is because one thing I've learned over the years of applying the wave principle real time is what I often see is that the context can change. If you identify a zigzag today correctly in any market, 20 years from now, when you go back and look at that same pattern, it will still be a zigzag. Patterns do not change. A zigzag, properly identified as a zigzag today, will remain a zigzag 5, 10, 15, 20 years from now. But the context of that zigzag, and what I mean by context is the actual identification of, is this a 2, is this a 4, is this a B, or is this an X wave? many times that context will actually change. This is why I focus a lot strictly on the actual pattern. Now, if we update our price chart, which is what we do as Elliott-Titians, we're constantly updating our price charts. Why? Because the price chart demands it. Each day, new price action unfolds. Each day, we have new evidence to evaluate. And we can either say that the new price evidence, the new price action, once we evaluate it, continues to support our larger forecast, our larger hypothesis, our larger outlook, or we can look at new price action and evaluate it and go, okay, we're not seeing what we need to be seeing at this juncture, so that puts the larger forecast into question. Now, in the case of Ctrip, despite the split that we experienced in early December, wave patterns are still pretty much the same. Waves 1, 2, 1, 2, acceleration gap in wave 3 of 3, 3, 4, and 5. Here we have an exhaustion gap in the fifth wave position. We're currently working a 3-wave decline. Here we have our Fibonacci support between 46.95 and 43.74, the 382 and 50% retracements of the wave 3 advance. Nearby we have the previous fourth wave extreme. As you know, if we apply the guideline of depth corrective waves, whenever a 5-wave move is complete, a retracement occurs that pushes prices back into the span of travel of the prior fourth wave, most often ending near its terminus. And of course, as we move forward in time, we're going to keep a very close eye out on the upper boundary line of our base channel, which typically provides support for fourth wave corrective price action. More importantly, as it stands, the move to the downside so far is still adhering to a 3-wave structure, waves A, B, and C. So ideally, as we move into possibly later this week, we may find a tradable low somewhere between, say, 46 and 43, preferably near that 45 handle. As Elliott-Titians, we're constantly evaluating price action. And as you know, one of the true values of the wave principle is that it puts price action into a context. Very important to understand that. The wave principle puts price action into a context. But what you need to understand is that as new price action unfolds on the hard right edge of your price chart, many times that will actually change the context of prior price action. That about does it for today. Thank you very much, and I'll see you tomorrow.